Question 1. In Illinois, a life insurance policy must contain a provision that allows the policy owner a minimum free look period to return the policy for a full refund. What is the minimum duration of this period? A. 7 days. B. 10 days. C. 14 days. D. 20 days. Answer: B. 10 days. The free look provision, also known as the right to examine period, grants policy owners a minimum of 10 days from the date they receive the policy to review it and decide if they want to keep it. If they choose to return it within this period, they are entitled to a full refund of all premiums paid. This essential consumer protection clause ensures individuals have adequate time to understand their new life insurance contract without immediate financial commitment, similar to a trial period for a major purchase. Always advise clients to carefully read their policy during this critical review window. Question 2. If a policy owner in Illinois fails to pay their life insurance premium by the due date, how long is the minimum grace period that the insurer must provide before the policy can lapse? A. 20 days. B. 25 days. C. 31 days. D. 45 days. Answer: C. 31 days. The grace period is a mandatory provision in all individual life insurance policies, including those in Illinois, providing a specific timeframe after the premium due date during which the policy remains in force, even if the premium hasn't been paid. This 31-day minimum grace period prevents immediate policy lapse, allowing the policy owner extra time to make the payment and keep their coverage active. For example, if a premium was due on January 1st and not paid, the coverage would still be effective until February 1st. This provision offers crucial protection against accidental policy termination. Question 3. Under Illinois law, a life insurance producer is required to deliver all of the following to a prospective policy owner at the time of application, except A. A buyer's guide. B. A policy summary. C. An illustration. D. A copy of the producer's license. Answer: D. A copy of the producer's license. While producers must be properly licensed, they are not required to provide a physical copy of their license to a prospective policy owner at the time of application. Illinois regulations, however, mandate the delivery of a buyer's guide and a policy summary to help consumers make informed decisions, outlining general insurance information and specific policy details. An illustration might also be required if the policy involves non-guaranteed elements. These documents are designed to provide transparency and clarity, ensuring the applicant understands the product they are considering. Question 4. Which of the following statements regarding the incontestability clause in an Illinois life insurance policy is true? A. It prevents the insurer from denying a claim based on misrepresentations in the application after 6 months. B. It voids the policy if the insured commits suicide within 2 years of policy inception. C. It prevents the insurer from denying a claim due to material misrepresentations in the application after a specified period, usually 2 years. D. It allows the insurer to contest the policy at any time if fraud is discovered. Answer: C. It prevents the insurer from denying a claim due to material misrepresentations in the application after a specified period, usually 2 years. The incontestability clause is a vital protection for policy owners, stipulating that after a policy has been in force for a specific period, typically 2 years in Illinois, the insurer cannot deny a death claim based on misstatements or omissions in the original application, even if they were material. This means that if an insured lived past this 2-year period, the insurer generally cannot contest the validity of the policy due to inaccuracies in the application, such as an undeclared medical condition. This provision provides certainty for beneficiaries, ensuring claims are paid without undue delay. Question 5. An applicant for a life insurance policy in Illinois intentionally misstates their age on the application. If this misstatement is discovered after the policy has been issued and the insured dies, what will the insurer typically do? A. Void the policy and return all premiums paid. B. Pay the full face amount of the policy. C. Adjust the death benefit to an amount that the premium would have purchased at the correct age. D. Deny the claim entirely due to misrepresentation. Answer: C. Adjust the death benefit to an amount that the premium would have purchased at the correct age. The misstatement of age or sex provision is a standard clause in life insurance policies that addresses situations where an applicant provides incorrect age or gender information. Instead of voiding the policy, which could be harsh for an unintentional error, the insurer will adjust the death benefit. This means the amount paid out will be what the premium paid would have bought at the insured's actual age or sex, ensuring fair treatment for both the insurer and the policy owner. It's crucial to always provide accurate demographic information on insurance applications to ensure the policy performs as expected. Question 6. Which of the following is considered an unfair trade practice in Illinois when dealing with life insurance policies? A. Explaining the policy's features and benefits to a client. B. Charging a fee for a policy review if disclosed beforehand. C. Offering a prospective client a portion of the producer's commission as an inducement to purchase a policy. D. Providing a client with a buyer's guide. Answer: C. Offering a prospective client a portion of the producer's commission as an inducement to purchase a policy. Offering a prospective client a portion of the producer's commission as an inducement to purchase a policy is known as rebating, which is an illegal and unfair trade practice in Illinois and many other states. Rebating is prohibited because it unfairly discriminates between policyholders and can lead to unhealthy competition, potentially undermining the integrity of the insurance market. Insurance transactions must be based on the policy's merits and terms, not on illegal financial inducements. Question 7. The Illinois Director of Insurance has the authority to do all of the following, except: A. Conduct examinations of insurers. B. Approve insurance policy forms. C. Prosecute individuals for criminal violations related to insurance. D. Issue, suspend, and revoke insurance producer licenses. Answer: C. Prosecute individuals for criminal violations related to insurance. While the Illinois Director of Insurance has broad regulatory powers to oversee the insurance industry, including conducting examinations, approving policy forms, and licensing producers, they do not have the authority to prosecute criminal violations. Such prosecutions fall under the jurisdiction of the state's Attorney General or local prosecutors. The director's role is primarily administrative and regulatory, ensuring compliance with insurance laws and protecting consumers within the state. Question 8. In Illinois, if a producer replaces an existing life insurance policy with a new one, which of the following is generally required? A. The producer must obtain the client's signature on a notice regarding replacement. B. The existing insurer must approve the replacement before the new policy can be issued. C. The new policy must be guaranteed issue, regardless of the client's health. D. The client must surrender the existing policy before the new policy is applied for. Answer: A. The producer must obtain the client's signature on a notice regarding replacement. When a life insurance policy is replaced in Illinois, regulations are in place to protect consumers from potential disadvantages like loss of benefits, new contestability periods, or higher premiums. A crucial requirement is for the producer to provide the applicant with a notice regarding replacement, which must be signed by both the applicant and the producer. This document informs the applicant about the consequences of replacing an existing policy and helps ensure they make an informed decision, similar to a detailed disclosure statement. Question 9. Which dividend option allows the policy owner to use the dividends to purchase additional coverage that is paid up and added to the policy's face amount? A. Cash option. B. Reduction of premiums option. C. Paid up additions option. D. 1-year term option. Answer: C. Paid up additions option. The paid up additions dividend option allows policy owners to use their policy dividends to purchase small, single premium whole life policies at their attained age. Each of these additions is a mini paid-up policy, meaning no further premiums are due for that specific addition, and they increase the policy's death benefit and cash value. For instance, if a policy pays a $50 dividend, that $50 could buy a small amount of additional permanent coverage. This option is popular for those looking to maximize their policy's long-term growth and death benefit without increasing their premium payments. Question 10. A policy owner has accumulated cash value in their whole life policy and decides to borrow against it. This loan is generally A. Taxable income to the policy owner. B. Required to be paid back by a specific maturity date. C. Subject to interest and reduces the death benefit if not repaid. D. Available only if the policy is fully paid up. Answer: C. Subject to interest and reduces the death benefit if not repaid. Policy loans are a feature of whole life insurance policies that allow the policy owner to borrow money using the policy's cash value as collateral. These loans are not taxable as income, and there's generally no set repayment schedule or maturity date, though interest is charged. If the loan, plus any accrued interest, is not repaid by the time the insured dies, the outstanding loan amount will be deducted from the death benefit paid to the beneficiaries. This means the loan essentially acts as an advance against the policy's future payout. Question 11. Which of the following non-forfeiture options provides the longest period of coverage? A. Cash surrender value. B. Reduced paid-up insurance. C. Extended term insurance. D. Automatic premium loan. Answer: C. Extended term insurance. When a whole life policy lapses due to non-payment of premiums, policy owners can choose a non-forfeiture option to utilize the accumulated cash value. Extended term insurance uses the cash value as a single premium to purchase a new term life policy for the same face amount as the original whole life policy, for as long a period as the cash value will allow. This option generally provides the longest period of continued coverage compared to reduced paid-up insurance, which provides a lower face amount for life, or cash surrender value, which ends coverage entirely. Question 12. Which type of life insurance policy offers flexible premiums and an adjustable death benefit, allowing the policy owner to increase or decrease coverage amounts? A. Term life insurance. B. Whole life insurance. C. Universal life insurance. D. Variable life insurance. Answer: C. Universal life insurance. Universal life insurance is a type of flexible premium adjustable life insurance that allows policy owners to change their premium payments and adjust their death benefit as needed. Unlike whole life, where premiums are fixed, universal life policies separate the savings element from the insurance element, providing more control over how premiums are allocated and how the policy performs. This flexibility can be appealing for individuals whose financial situations or coverage needs may change over time, offering a customizable approach to permanent life insurance. Question 13. All of the following are characteristics of variable life insurance policies, except A. The cash value is invested in a separate account. B. The policy has guaranteed minimum cash value. C. The death benefit may fluctuate based on investment performance. D. The policy owner bears the investment risk. Answer: B. The policy has guaranteed minimum cash value. Variable life insurance policies are unique because their cash value and death benefit, above a guaranteed minimum, are directly tied to the performance of underlying investment options, known as subaccounts, which are held in a separate account. Because the policy owner chooses these investments and bears the investment risk, there is no guaranteed minimum cash value. Its value can fluctuate and even decrease. This contrasts with traditional whole life insurance, which offers guaranteed cash values. Producers selling variable life products must hold both a state life insurance license and a FINRA securities license. Question 14. What is the primary purpose of the entire contract provision in a life insurance policy? A. To allow the insurer to change policy terms at any time. B. To ensure the policy owner can only make changes through an agent. C. To state that the policy document and the application constitute the complete agreement between the insurer and the policy owner. D. To define the rights of the beneficiary regarding policy ownership. Answer: C. To state that the policy document and the application constitute the complete agreement between the insurer and the policy owner. The entire contract provision is a fundamental clause in a life insurance policy that specifies that the policy itself, along with a copy of the original application, forms the complete and exclusive agreement between the insurer and the policy owner. This means that nothing outside of these documents can be considered part of the contract, preventing either party from later introducing additional terms or conditions not included therein. This ensures clarity and prevents disputes over the terms of the agreement, for example, by preventing an insurer from referencing unwritten promises made by a producer. Question 15. An annuity payout option that guarantees payments for the life of the annuitant, but if the annuitant dies before a certain number of years, the payments continue to a beneficiary for the remainder of that period, is known as A. Straight life annuity. B. Life annuity with period certain. C. Joint and survivor annuity. D. Fixed amount option. Answer: B. Life annuity with period certain. A life annuity with period certain payout option provides income payments for the annuitant's entire life, ensuring they never outlive their income. However, it also includes a guarantee that if the annuitant dies before a pre-selected period, example 10 or 20 years, has passed, the remaining payments for that guaranteed period will continue to a designated beneficiary. This option combines lifetime income with some assurance that a portion of the investment will be paid out even if the annuitant dies prematurely, offering a balance between longevity protection and beneficiary security. Question 16. In Illinois, which of the following actions requires a producer to be licensed? A. Discussing general insurance concepts with a friend. B. Referring a client to another licensed producer without receiving compensation. C. Negotiating or soliciting an insurance contract for compensation. D. Attending an insurance company's informational seminar. Answer: C. Negotiating or soliciting an insurance contract for compensation. An individual must be licensed as an insurance producer in Illinois to engage in activities such as negotiating, soliciting, or selling insurance contracts for compensation. Simply discussing general concepts or making uncompensated referrals typically does not require a license. The licensing requirement ensures that individuals who are actively involved in the sale and service of insurance products are knowledgeable, ethical, and accountable to the state's regulatory authority, protecting the public interest. Question 17. The primary purpose of a suicide clause in a life insurance policy is to A. Prevent the insurer from paying claims if the insured dies by suicide at any time. B. Reduce the death benefit paid if the insured dies by suicide within a specified period, usually 2 years. C. Deny the claim if the insured dies by suicide within a specified period, usually 2 years. D. Pay an increased death benefit if the insured dies by suicide. Answer: C. Deny the claim if the insured dies by suicide within a specified period, usually 2 years. The suicide clause is a standard provision in life insurance policies that states if the insured commits suicide within a specific period after the policy's effective date, typically 2 years in Illinois, the insurer will not pay the death benefit. Instead, the insurer will usually return the premiums paid to the beneficiaries. If the suicide occurs after this initial period, the full death benefit will typically be paid. This clause is designed to prevent individuals from purchasing a policy with the immediate intent of committing suicide, thereby protecting the insurer from adverse selection. Question 18. A life insurance policy's cash value growth is generally A. Fully taxable as ordinary income each year. B. Tax deferred, meaning taxes are only paid upon withdrawal or surrender. C. Exempt from all taxation. D. Subject to capital gains tax annually. Answer: B. Tax-deferred, meaning taxes are only paid upon withdrawal or surrender. The growth of cash value within a life insurance policy is generally tax-deferred, meaning that the earnings accumulate without being subject to current income taxation. Taxes are typically only incurred if the policy is surrendered for its cash value and the amount received exceeds the premiums paid, or if withdrawals are taken that exceed the policy's cost basis. This tax-deferred growth is one of the significant advantages of permanent life insurance, allowing funds to compound more rapidly over time. Question 19. If an insured dies and the primary beneficiary has already passed away, the death benefit will typically be paid to the contingent beneficiary. This arrangement is known as A. Per stirpes, B. Per capita, C. Revocable beneficiary, D. Irrevocable beneficiary. Answer: A. Per stirpes. When beneficiary designations are made per stirpes, it means that if a named beneficiary dies before the insured, that beneficiary's share of the death benefit will pass to their living descendants, rather than being divided among the surviving named beneficiaries. For example, if a policy designates 2 children per stirpes and 1 child dies, that child's share would go to their own children, the insured's grandchildren. This method ensures that family lines receive their intended share, even if a direct beneficiary is no longer alive. Question 20. Which of the following is a characteristic of group life insurance? A. Each individual insured receives a separate policy. B. Evidence of insurability is always required for each individual. C. The employer is typically the policy owner, holding a master policy. D. Coverage is typically more expensive than individual policies. Answer: C. The employer is typically the policy owner, holding a master policy. Group life insurance is characterized by the fact that a single master policy is issued to an eligible group sponsor, such as an employer, union, or association, covering all eligible members of that group. Individual members then receive a certificate of insurance, which is proof of their coverage. While individual insurability might be required in certain circumstances, like for very large amounts, it's generally not required for basic group coverage, and it is typically more affordable than individual coverage due to the economies of scale and broad risk pool. Question 21. All of the following are common non-forfeiture options in a whole life insurance policy, except A. Cash surrender value, B. Extended term insurance, C. Reduced paid-up insurance, D. Annuity payout option. Answer: D. Annuity payout option. Non-forfeiture options are choices available to a policy owner who stops paying premiums on a permanent life insurance policy with accumulated cash value. These options allow the policy owner to retain some value from the policy instead of forfeiting it entirely. The 3 standard non-forfeiture options are cash surrender value, extended term insurance, and reduced paid-up insurance. An annuity payout option is a method for receiving income from an annuity contract, not a non-forfeiture option for a life insurance policy. Question 22. In Illinois, a life insurance producer's license is typically valid for how many years before it must be renewed? A. 1 year. B. 2 years. C. 3 years. D. 4 years. Answer: B. 2 years. In Illinois, a life insurance producer's license is typically issued for a term of 2 years and must be renewed biennially. Along with renewal, producers are generally required to complete a certain number of continuing education (CE) hours to ensure their knowledge remains current and they stay informed about industry changes and regulations. Staying on top of license renewal requirements is crucial for all insurance professionals to legally continue transacting business. Question 23. A prospective client in Illinois receives a detailed document illustrating how a life insurance policy's premiums, cash values, and death benefits might perform over time, including both guaranteed and non-guaranteed elements. This document is known as A. Policy Summary, B. Buyer's Guide. C. Illustration. D. Producer's Statement. Answer: C. Illustration. An illustration is a document used in the sale of life insurance policies that shows projections of policy values, including premiums, cash values, and death benefits, over a period of years. It typically includes both guaranteed values, which the insurer is contractually obligated to provide, and non-guaranteed values, which are based on assumptions about future interest rates, mortality, and expenses. Illinois regulations require insurers to provide illustrations for certain types of policies, helping consumers understand the potential long-term performance of their policy. Question 24. What is the primary difference between a revocable and an irrevocable beneficiary designation in a life insurance policy? A revocable beneficiary can receive policy loans, while an irrevocable beneficiary cannot. B. A revocable beneficiary can be changed by the policy owner at any time. An irrevocable beneficiary cannot be changed without their consent. C. An irrevocable beneficiary receives a larger death benefit than a revocable beneficiary. D. A revocable beneficiary must be a family member, while an irrevocable beneficiary can be anyone. Answer: B. A revocable beneficiary can be changed by the policy owner at any time. An irrevocable beneficiary cannot be changed without their consent. The key distinction between revocable and irrevocable beneficiary designations lies in the policy owner's ability to change them. A revocable beneficiary can be changed by the policy owner at any time, without their consent, as long as the policy owner is alive. Conversely, an irrevocable beneficiary's designation cannot be changed, nor can the policy owner exercise many of their ownership rights, like taking a loan or assigning the policy, without the irrevocable beneficiary's written consent. This makes irrevocable designations much more restrictive for the policy owner but offers greater protection to the beneficiary. Question 25. The payer benefit rider in a juvenile life insurance policy is designed to: A. Pay an accelerated death benefit if the insured child becomes terminally ill. B. Allow the policy owner to increase the death benefit at specific intervals without evidence of insurability. C. Waive premiums if the policy owner, payer, becomes disabled or dies before the child reaches a certain age. D. Provide additional coverage for the child's college expenses. Answer: C. Waive premiums if the policy owner, payer, becomes disabled or dies before the child reaches a certain age. The payer benefit rider is a common addition to juvenile life insurance policies. Its purpose is to ensure that the policy remains in force even if the adult paying the premiums, the payer, usually a parent or guardian, becomes totally disabled or dies before the insured child reaches a specified age, typically 21 or 25. If such an event occurs, the premiums for the child's policy are waived, protecting the child's coverage and ensuring it can continue to grow. This rider provides crucial financial protection for the child's future insurability.